Hello there, Ray. How you doing?
Oh, pretty good, Ray.
What's up, buddy?
Well, I have an IRA, and I have it with a mutual fund with Vanguard. And I was wondering, as far as diversification, I know the bond, they're paying hardly anything, and I was just wondering, is there some other product to diversify into, or just stick with what I have in the mutual fund?
Well, let's talk about it. I mean, you're talking about bonds. Is this mutual fund designed, Ray, to give you income right now? Do you want growth? Do you want a little growth and a little bit of income? What is this IRA invested for?
Well, it pays a dividend and income.
Okay, so how much is in the IRA?
$100K.
And are you taking the dividend right now?
No.
And how much of a dividend are you receiving?
No, it's reinvested into the. Well, it's just at the end of the year they pay you the dividend in it.
No, I get that. I understand that. What fund is it? Is it a growth fund, an income fund? Is it a bond?
Yeah.
Did you say it was bonds? All bonds?
No, it's a Wellington Admiral.
Okay, so it's a growth and income fund. It's actually a very good fund. Not that I ever give out recommendations on funds, but I know the folks at Wellington, have known them for a number of years, and they're decent money managers. So you can do nothing and leave it alone. Would I do nothing? No, I would do something totally different than that. I would try to figure out what's my long-term goal with this money. For example, may I ask you a couple of questions?
Sure.
All right. When do you think you're going to start taking the money from this fund and spending it? Or is this money to be left for your kids and grandkids?
No, I'm going to work till 70, then take it.
All right. So we have a 10-year time horizon for this money. Actually, to be honest with you, this fund is a pretty good fund for a 10-year time horizon. What I would do is I would break this down into a few other buckets. And I would include, and this may be the bucket that I use for my stock market growth and income bucket, but I would have some safe money in here for liquidity in the event that sometime before 10 years from now, you might need to tap into this money, and it happened to be one of those rare times when this fund takes a nosedive. I would want to add some high-yielding investments, alternatives such as real estate investment trust, because in this particular fund, you're not getting that kind of exposure. But having said all of that, I think if you left it alone, you'd be okay. But stay on hold. I'll have you talk to somebody that might offer you some minor tweaks, okay?
All right, thank you.
All right, thank you very much for the call. Listen, this is a classic growth and income fund. It's inexpensive from a fee standpoint, and it buys primarily, dividend-paying stocks? Stocks that pay dividends. I don't know, in a market like this, that doesn't sound that bad to me. So maybe, just maybe, if it were me, I'd take maybe half of this money and leave it there and do something with the other half. Maybe have some more protection on downside risk and some higher income yielding real estate, for example. Because if I can get a 5, 6, or a 7% yield, my suspicion is that fund is yielding 2 to 3. So I can double my yield, have a little bit more income, have a little bit more safety, and still reserve the rest for long-term growth, so that, and this is why it's so important, if Ray loses his job right now and needs income, he doesn't know he's not going to get fired. Or loses his health, he doesn't know he's not going to lose his health. So my position has been and always will be, regardless of your age, regardless of your circumstances, you must always build a portfolio that is adaptable enough to your changing situation. I lost my job. I now need to tap into this. I need $4 or $5 grand a year, or $300, $400, $500 a month from this portfolio. Oh, but the market just dropped 58% like it did, peak to trough in 2008, 2009. I don't want to take $5 grand out of my 100,000 just turn into 42,000. You see what I'm saying? You don't know that's not going to happen on the day that you need the money. So from that standpoint, you bucketize it. Now, everybody's bucket plan is a little bit different. If you want to be a little bit more aggressive, you dial down the safety. but you still have those income-producing investments, and you still have enough safe money to get you through a cycle. How long can a cycle be? Well, the worst it's ever been is a 4-year downturn, where the markets went down for 4 years straight. That was the Great Depression. Remember, we had 3 years, 2000, 2001, and 2002. Markets went down, down, and down, and then they came roaring back again. So if you want to be safe, get 3 to 4 years of super safe money. Let's use 4, and let's use a 4% distribution for Ray. So how would I build his portfolio? 4 years, I'm going to be aggressive now, 4 years at a $4,000 or 4% distribution on $100,000 is $16,000. So I'll call that 15% or so. 15% of his money in cash-like instruments, maybe short bonds. Maybe 20% in real estate. We learned in the first hour that produced a better rate of return than having no real estate. And then the rest he can leave right where it is. Thank you, Jim.
The Ray Lucia Show.